Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seamer interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seamer.
All right, everybody, welcome back. Another episode of the Apartment Guys. Today we have Mr. Salvatore Buscemi in the house. Sal is an accomplished author. He wrote a killer book called Investing Legacy. If you're watching on YouTube, here's a copy of it, or here's the front page of it, the front cover of it. How the 0.001% invest, not the 1%, the 0.001%, the uber wealthy, how they either created their wealth or preserved their wealth. And hint, hint, it has a lot to do with real estate and commercial real estate in particular. So we get deep into some of that stuff. We talk about knowing who your investors are and how to market to them well, how to talk to them, like what's important to them, what their values are, what they do for fun, etc. And I want you to go and check out the free download that Sal has at investinglegacy.com. Again, investinglegacy.com. Go check out his free download. It's worth doing. Check that out now. And then also, while you're at it, if you haven't checked out our landing page recently, it's worth looking at. We have some new properties up there that we're working on and some new properties that we've acquired. And so that's at www.investwithgreenlight.com. Again, www.investwithgreenlight.com. That's where you can find me and get in touch with me, schedule an appointment with me to talk more in depth about investing and possibilities around that. So I'm here to help any way I can, and let's partner up, do some deals. So without further ado, let's jump right into this with Sal Buscemi. Well, here we are back on the Apartment Guys, and we've got Sal Buscemi in the house with us to play ball and to hang out. This is like dude hour in the middle of the afternoon for us, and we're going to hang out and talk some shop and learn about raising capital and really get into some fun, good, actionable items and great resources and everything else. But Sal, I just want to welcome you to the show. Thanks, brother, for being here.
Thank you for having me. It's a pleasure and a privilege. Thank you. I like your background. It's much more Bob Ross-ish compared to mine. It's much more sterile and institutional, but
yeah, this is for the listeners. I've got a bad mountain background behind me. That's from the Alta ski resort, which is about a half hour from my house here in Salt Lake City. So that's the
beautiful. I used to ski on Alta all the time. Fly out, direct flight, 3.5 hours from LaGuardia, go out to Alta. Was it Snowbird? Yeah,
Snowbird.
Go out to Snowbird. Yeah, it was a lot of fun. We used to go out there a lot on like President's weekends and stuff.
I'm smiling big. Snowbird's my truly my winter home. I spend 50 days a year at Snowbird probably, and Alta to a lesser degree, but I love it out here and talk about it for a long time. I've been here 21 years and kind of handpicked it as a place to move to when I moved from Cincinnati in my 20s. So
good move.
Yeah. Thank you. I appreciate that. So Sal, if you could just kind of help us, help the listeners and me just kind of understand a little more about you and kind of give us a little color into the background, the bio, the man behind the myth sort of thing.
The man behind the myth, right?
Love to hear more about you.
Well, my name is Sal Buscemi. I'm originally from New York. I live in a tax haven now known as Las Vegas. Mm-hmm. And that's been very important now, and even more important after the pandemic for reasons of taxes and, the whole global migration, which we're starting to see right now. I started my career, I thought in college. I went to school in New York City, went to college in New York City, worked in New York City after college, thinking that I wanted to become a doctor. And I found out earlier on, and I actually had sort of a sit down with my father and his cronies, and they said, you really don't want to get into this. And this is like 1996. And it was kind of depressing that summer because I was going into my senior year and I had to take 23 credits and 22 credits respectively, and everybody's outside having fun and drinking beer. But, I had this internship that I was, sort of dead on because I was like, I'm going to stick with it. I'm sort of hard-nosed and I'm going to get through the senior year. Senior year is not fun, but I learned a lot, and, I continued to help this doctor that I was interning for. Push comes to shove, and this is in my latest book, Investing Legacy, that I just published about a month ago, and we're starting the PR now with it. This doctor sort of befriended me, and because of the work that I did for him, he was able to refer me to someone who worked at a company called Goldman Sachs in New York. And so, because of
I've heard of that company, I think.
Yeah. I know.
They've been around for a little while, right?
Now moving to Dallas, right?
Right.
If you would have told me that 20 years ago, I would have thought you were using needle drugs tape, but that's a whole other story. And that's a whole other podcast we can riff about, over a couple beers. But it basically got me into a job where I was able to learn from the best people in the world. And around 29 years old, I raised $30 million institutionally from a $2 billion asset manager on Park Avenue in New York. And they said, it's out. We get it. Here you go. And so we basically became the kitchen sink for Bear Stearns at that point, who was facing like a lot of foreclosures because they just lent on some really rough product, really rough mortgages. So we were buying the whole loans and we were turning them around. We were buying them by the gallon and selling them by the shot. Wow. But we were making a profit off of it. So that's what we were doing. So in Cincinnati, say your hometown, there's a lot of like very rough product, very non-conforming mortgages that were there that we were able to buy at a discount. Did the same thing in Las Vegas. I wrote my first book about it. In 2013, real estate got a little funny. And we decided to do other things. I leveraged my network and the families that had invested in me in real estate to go into other things and to venture. And that was mostly life sciences focused. And this is through my network in New York, where we were able to allocate into certain deals that are doing very, very well. And, I'll send you a copy of the letter and, a link to it if people want to see it. But I write an annual letter to the LPs in the deal and to the fund. And it has an MOIC of 4.32, which is really nice. And we've been able to do that because we have a good reputation of doing what we say we're going to do. And we also have a very good network as well. And right now in real estate, we're doing kind of a combination of a couple things. We're allocators first and foremost. We don't take fee. We're not owner operators. We allocate alongside best in class owner operators. So that would be people who have been around for a while. There's on our website, there's a profile. We work with a family who we like working with who does industrial, and we're going to do a lot more industrial, Class A industrial with it. We're also doing some office in Austin, and we're also doing my favorite, something which is interesting called life sciences office, life sciences real estate in Boston. So when you think about it, all these people who are working on cures for COVID, I think life sciences and healthcare is going to be the next, the roaring 20s coming up. And so we want to be in part of that too. And so we're investing into some of the parts of the country that are experiencing growth, but we're also taking our bets too by investing in GPs of mezz lenders and people who are going to be on the vanguard, so to speak, of when the distress comes. We'll be able to see a lot of things and capture equity upside from that, or what we call equity recognition from that standpoint. So I've been like you doing a lot of busy work. We've been preparing legally. Perkins Coie is not cheap. I'll never have a new boat again after paying them, to do our docs, but we do it the right way. And we do it because, we want to show to our investors that, look, we take your money serious. I mean, these are high-end investors that I have, so they have certain expectations. But it's setting the foundation now. And you and I were talking about this earlier, is that you have to set the foundation now because what's coming is going to be incredible. And anyone here who's interested in the business should probably be aligned with someone like you before they start doing it themselves. And I always tell people like, oh, I want to learn how to do industrial. I'm like, It doesn't happen that way. It doesn't, if you want to learn, you look over the shoulder by writing a check into someone. So, for people who, think that they have the stomach to become a multi-family operator, say, or owner operator, and let's just say they happen to be a doctor, that's usually where a lot of the catastrophe happens.
Yeah.
Because people are not really a good match. So if you're learning to get into the business, you want to follow along, work with people with Tate first. That's what I would say.
Yeah. Wow. Lots to unpack there.
Yep.
That's fantastic stuff. So boil it down a little simply. What activity are you guys doing with multifamily asset class, if any, at this point?
We're multifamily right now. We're looking into actually actively developing in Austin, in Round Rock, Class A multifamily.
Okay.
We're starting to see a huge trend move towards Austin, even
Yes.
though they didn't fare too well during the pandemic, and then they also had the whole ice storm, unfortunately, too.
Right.
Needless to say, it's still a growing city. It's still demographically going to grow and come into its own, much like Las Vegas has. So we've looked at the Sun Belt. We're doing a lot into that. And then really what we're looking at now in multifamily, and it's coming down our pike, is that you're seeing a lot of people who overpaid for multifamily going into the pandemic, before the pandemic. And because of the relationships we have, we're starting to see where loans can be sold at a discount to guys like you, for these Class C, Class B type of stuff, in those cities at a good discount. And I think what you're going to see is that there are going to be banks that are going to be selling a lot of these loans off, because a lot of these guys are blowing through debt covenants and their DCRs and all sorts of, things that they, should, quite frankly, if they didn't overpay to do, they should have had the reserves to, to take care of. But I think that's what we're waiting for, that opportunity to come. And that's how we're playing multifamily, is by playing it with distressed credit. That's the way it's easiest, it's smoothest that way. You don't have to worry about being outbid by a bunch of doctors and dentists, and you get a much better basis.
Got it. Makes sense. Being outbid by doctors and dentists. I feel you on that.
You're laughing, Tate, because it's true.
I'm laughing because it's true. It's true. It's not quite. I'll say this. Generally, you're up against other decent investors and syndicators that are funded by doctors and dentists, for sure, right? But I mean, once you do end up with people that have W-2s or careers or are chiropractors or whatnot, and or registered nurses. I've had a few on the podcast that are full-on career folks, and they're the ones that I've had on the podcast are exceptional at what they do. So they figured out a way to make a pretty big impact, a pretty big splash in the multifamily space with it.
Yeah, because they're trained procedurally to do that. Sure.
Yeah. So, but like, I think it's few and far between that you see people that are real successful at, in that space, that hold on to a W-2 for too terribly long. It's the golden handcuffs thing is real. So, it is, but I'll tell you what it really comes down to. If you want to be in this business, you have to be always raising capital. And if you're not confident in sales, and you're not always closing, sort of say, and you're not always telling people what you do, and your own ego and identity gets in the way, and you're like, well, I'm a nurse, but I also do part-time investing. Right.
Yeah, it's because you're not showing any conviction to your investors. You need to be really showing conviction to your investors.
Yep.
That's really what it is. If you go around and saying you're half in and half out, and then you're doing CBD sales on the side, and then there's a new fitness app that I'm trying out, and you should too, you're not going to build any credibility, right? It's just not going to work. So the people who want to get into this are the people like you who are out there knowing that you have to spend 50% of your time raising capital. That if you're a syndicator, you're in real estate, you're always raising capital, always. And a lot of people don't like to do that. They just think, well, I'm a doctor or I'm an accountant, and the money will come automatically. And they figure out, no, that's not really the case. And then they also figure out, unfortunately, that they might not have the personality for it, and they're better off basically investing into operators like you, or someone else who has consummate experience, rather than trying to do it themselves. I see it all the time with families too. They'll come into a tremendous windfall, and then they want to start becoming a developer, and they have no idea what they're doing. They're very techie, they don't really work well with people, but now they want to become a developer. And that's, how a lot of wealth was lost in 2008, 9, and 10, actually.
Yeah. We tried developing a little bit too, and didn't do particularly well with it. And it was a good kick in the pants learning experience for us anyway, at that point. Yeah. It is squarely at purchasing, acquiring, and operating cash flowing, profitable multifamily assets that are risk mitigated, that are well leveraged, that have good fixed rate debt on them, that, et cetera, et cetera. It's kind of the opposite of speculative development, really. First of all, the two activity sets couldn't be more unrelated, really, in a lot of ways, right? Like, except for that maybe you're raising money for both, but and the risk level couldn't be more different between purchasing something that, now if you're talking about a speculative buy on an apartment where you're buying something for more than what it will support on a debt coverage ratio, that's one thing, right? And that's what you see in places like Austin, quite frankly, and Salt Lake City, where I am. You see people buying for sub 4 caps, and those are never going to pencil, and they're never going to cash flow. So my team, we're in Oklahoma City and we're in Columbus, Ohio, and those are our two master markets, and we're going hard and heavy at those because we know we can get there, and it's positive cash flow, and that's
Oklahoma City, steady Eddie too. It always has been. It's growing as well. It's a great city. Austin, I think you're going to see, and you hit the nail on the head, and you sort of validated my point later, is that there's a lot of these apartment owners who came in who don't know what they're doing, and that debt is going to be stressed. Right? You have to think of the capital structure like a match. If you light a match, right, the equity gets burned first, and then the mezz, and then you get down to the debt, and that's where you start seeing problems, and that's when the lenders come in and start affecting legal and forcing all sorts of contingencies. So we haven't seen that happen yet, but we're waiting for it actively, and we have a world-class multifamily operator lined up when that comes, so that we can allocate equity into these opportunities to be able to turn them, and of course to be able to work with guys like you too.
So when let's get back on track here with kind of the multifamily space and raising capital. And let's kind of start from the space of let's go to your book and tell us kind of the gist of that, and how the overarching themes in your book kind of can inform us as syndicators, right?
So there's something that I wrote in the book that has gone over very well before to the audiences that matter and the guest contributors. And people who are raising money need to know who they are asking money from, because all capital sources have different needs. And so I put together the 5 legacy avatars. And those avatars have different personalities because they have different egos and they have different ways of asserting their status. So I'll just go over one of them. The provider. Okay. The provider is someone who might look like an accountant. He has square rimmed glasses. He doesn't like to be embarrassed. He, has a solid handicap. He wears cap toe shoes, and he is a very good, whatever he is in society. He's just that guy. That's the person who's going to be an investor in multifamily. Okay. The person who's not going to be an investor in multifamily is what we call the mogul. This is the guy that wears his risk profile on his wrist. He's into venture. He's into crypto. He's into everything that's liquid. He's into things because he wants to make a quick buck. He's trying to make a name for himself. He has money, but he's trying to exert himself into further influence. So he's trying to show his status as it relates to his portfolio. So he's not going to be a guy for that. And a lot of the people who start out investing will say, "Oh, I know this guy. He's got a couple million in crypto. He might invest in my apartment deal." I say, no, he's not. He's not, because he has the attention span of a gnat, number one. And number two, he has a different value system than you do. He really does. And the ultimate test for anyone raising capital, I'll say, and this is something that we talk about internally at my firm. It's how important is liquidity to you? If you value liquidity like it's your life, you're not rich. Okay, you're not rich. Right. All right. Very wealthy people have cash flowing assets. Liquidity is a burden to them, and that's why they work with guys like me to put that and allocate it into other things. They have operating businesses, or they've had an exit on a company where it's $350 million or something. They need to know what to do with that money. They're not going to go out there and buy Rolls Royces and all that kind of stuff. So different people have different personalities and identities, and that leads to the type of investors and what they want. I think when you're raising money from these providers, it's not so much about, if I may continue, it's not so much about the numbers. It's more or less, I think, that you're catering to their ego somehow, and we've done this before where, it's just simple. And one of my friends who's the head of asset allocation for Pacific Life gave me this idea. It's, if you put someone in front of an apartment complex that you're syndicating and say, hey, if you give me $250,000, I'll put you on the roof of it, and a drone will take a photo of you and your family, and you can post it on Instagram, you're going to get that check much faster than if you're trying to pitch it. It's like, well, it pays, it has an IR of like 14 and things like that. If you make them part of the process so that they can show it off and get their dopamine hit themselves, then that's a lot. And that's why you start seeing a lot of videos. If you go to DandrewPartners.com, you'll see we use videos, not only for real estate, but for other things, because people want to send those videos to their friends to say, hey, I invested in an apartment building. You're still doing all this crypto crap. So it becomes, more of an extension of influence. Plus it's a liquid too.
Brilliant. I love it. Okay. So the provider, I was taking some really detailed notes there as you were talking. The provider is your accountant type. He's got a good handicap. He's a golfer, probably country club type. He's going to be investing in multifamily. What are the ego strokes for somebody like that?
He wants notoriety. That's what he wants. He wants somehow to be linked to that investment in a way where he can say that he's made something else. And the way it is talking about other sophisticated investors who are in that. That's always something that's a win. Or talking about other people who are involved in it. Other things that you can talk about, I like to talk about, is basically, who the operator is, their history and their track record, why it's better than anything else. Something that they can talk to their wife about. Because if they can explain it to their spouse, then you're guaranteed a ticket. But really, what they're seriously, if they can, because I'm
not laughing. I'm laughing with you, not at you. I know that's true. Yeah.
Yeah,
absolutely.
Because if they can't, because remember, he has an ego too, and now he has to go to his wife, and his wife's probably thinking, "Oh, great, another deal again where you're going to lose money. How is this one different?" And that's what you need to do, is you need to answer that in a way where they can actually tell their spouses, "No, this is better. Here's why. We're not, this guy has experience. He's already done this. This isn't a part of town. Other investors are sophisticated in it." And, any other sort of sizzle points that you can think about. But to close the deal, a lot of these people, especially newer investors, they want it, and I'm not picking on doctors and dentists. It just happens to be the way it is. But in order to get their attention, they want to show their other friends who are in crypto that they're in this multifamily apartment syndication, that there's other sophisticated investors in there, and it's only invite only. So the way you make it, the more you make it sound like that, the easier it is to be able to raise capital for those. And another thing we like to do too, and I don't have one available, but Airbnb just went public, and we were one of the earlier investors in that. And so the CEO sends us himself a deal toy, and it's basically a piece of acrylic, right? I mean, it's a piece of acrylic. And what we do is we put together now for all our investors, and this is really what they like, is a deal toy. And it's an acrylic deal toy. I mean, basically it's acrylic and has a CAD drawing of the apartment on it, or the piece of real estate. And then it has underneath it the date it closed. And then it has, something, limited partner, limited, it doesn't say their name, but it says limited partner. So now when they go over to their office or house, they see this thing, and people are like, well, what's that? It's a status symbol. See what I mean? It's a status symbol all of a sudden.
Absolutely.
And that's what they like. That's why we have deal toys. I mean, that's why we have deal toys. We give it out. It's a status symbol. You go to someone's office, it's like seeing like Super Bowl rings on Tom Brady. It's like, oh, you hear, you see all these deal toys. And I'll send you a picture of one in New York that one of our, he took 70 companies public, and he has this beautiful piece of furniture with all these acrylic deal toys on it. But if you treat your investors like rock stars, the money will come. But if you're doing that in a home in Oklahoma City and nobody knows about this, and it's a small area and people are starting to see a green light acrylic deal toy, that's a little different now, right? That's a little different.
Yeah, no, that's powerful. I love that. Deal toys. Okay.
Everybody in Oklahoma City knows someone that does acrylic, right? It's not.
Right. Yeah, that's for sure. So that's great. That's a great takeaway for us, for my team. We're gonna use that. And I think, anything that physical that you can put in an investor's hand. Corey Peterson does binders, right? Where it's a real nice leather binder that's embossed, and it's got all the details of the investment inside, pictures.
Yeah, it's like an owner's manual to a car. You want the hood ornament.
Right.
Yeah.
Right. You want to have that.
People don't steal the owner's manual. They steal the hood ornament. Give them the hood ornament.
Right. Right. Give them the deal toy. I got it. So, okay. So throw me out a couple other deal toy ideas. What else have you done?
Oh my gosh. You know what I've done is that's something that's really great. And this is great because I'm always raising capital, right?
Yeah.
So it's not so much a deal toy, but it's the networking. And there are these places where, in any major town, I think you're in Denver around, is that correct?
Salt Lake City. Yeah. Yeah.
Oh, sorry. Salt Lake City. Sorry about that.
No problem.
Definitely in Salt Lake City, there are these Brazilian restaurants, right? These rodizio places.
Yeah. Yeah.
And what I like to do is I like to have a closing dinner with investors. And so if I'm in New York, I'll have a few of the investors come out. Now, not all of them is going to make it out, right? Because there are some investors who, excuse me,
they're too busy in this investment, just an afterthought for them. Am I?
Well, no.
Okay.
Some of them are not going to show up because let's say the investment's in Las Vegas, and some investors are from Dallas, some are from Southern California. Okay. But I'm in New York. I'm going to have a closing dinner, like, oh, we're going to celebrate, and we're going to have fun. Sorry, you can't make it. However, do you know anyone in New York who might want to come just to celebrate with us and meet some other families? Mm-hmm. So now it becomes a hodgepodge of qualified people meeting each other who would never be able to work together. And that networking and that interactivity is the new currency, especially with the high net worth families with over $100 million that I work with. Is they're not looking to get rich. They're looking to put another layer of their legacy on. And that's why I wrote the book, Investing Legacy. It's, hey, it's just another way to meet other people, because it's like, hey, I was in this deal. It closed. It's great. We just got our refinance check. Sal's having a party in New York at, some, Rodizio. And I choose those places because you can get them for like probably $65 a plate. So for like $2,000, you can put on a great time, but you can also meet a lot of investors too. And that's very important. Like a lot of the important investors, not the ones who are just, coming along just to, see what's going on. These are people who are the highest referrals because you've already given them a check and that trust has already been established.
Yeah. Yeah. Boom. That's brilliant, dude. I love it.
Mm-hmm. Yeah.
Awesome. Good stuff.
I'm telling you, if you were to go back, Tate, and you were to spend maybe like $1,200 going back to your investors, and you were to give them a deal toy from each one of these, you would, and they were to receive one each week for each apartment complex you were telling me about earlier, you will have no problems raising capital going forward from these people, because they'll want. Do you remember? It's psychological, because think about it. Do you remember the old Franklin Mint commercial where you get the chess piece?
I don't know that I do, Sal.
Okay, you're too young for that. Okay, well, it used to be.
I think I'm older than you, dude. But I missed that one somehow.
Okay, well, the problem is that they would have. It's not a problem. They would sell chess pieces on a monthly basis, and nobody would quit the subscription because they didn't want to not have a complete chessboard. Mm-hmm. You can do the same thing by giving people a chessboard, because psychologically they want that next trophy. They don't want not to have a trophy.
Mm. Oh man, that is good stuff. Awesome.
Yeah.
Love it. All right. So,
yeah.
All right. So switching gears a little bit, tell me a little bit about your company and what you guys are up to. Dandrew Partners. You're a multifamily investment firm. Tell me kind of how you guys do things.
Yeah, we are not owner operators. We just basically allocate into companies, and these companies are the deal flow we get mostly from New York and mostly from successful deals and CEOs that we've known in the past. And our rule across the board when we allocate into anything, whether it's in real estate, private equity, venture, special situations, is that we like to have a strong operator who's done this before. Number two is we also like people who are putting, money into the game, their own equity. Sometimes that's not always needed if you have these rock star CEOs. But most importantly, what I want to see, especially on the venture side, is that they have actually had multiple exits. It's one thing to start a business, but it's an entirely different thing to sell it. If you start a business, you're supposed to sell it at some point, whether it's to your family or someone else. Yeah. There's got to be a way for you to get cash out of that at some point. It's interesting because it sort of changes the deal flow, and you start seeing more qualified deal flow, which leads to better success. Being an allocator. And it's also the partners who I have too as well, who I've been working with for years. There's a lot of trust, and they have similar experience. Like, I'm known as a real estate guy, but my counterpart, my partner, is a venture guy, and he's a real venture guy. Like, he started his own venture fund at 26 after leaving Harvard Business School. So, he's about as hardcore as, anyone else would usually get on Wall Street when it comes to this stuff. But working with the best people and following along to the commitments and following along and communicating to our investors throughout the whole part has given us a lot of success. And over the past year during the pandemic, I spent a lot of time basically redoing the website, redoing our culture, redoing a lot of things as it relates to how we're positioning ourselves from a structural standpoint to prepare for, I think, some interesting things that are happening in the economy, but being able to invest and allocate into these niche opportunities, which I just love doing. And, I'm a financial nerd, like I was telling you about before, like GP interest in like a mezz fund in New York City, that's really cool stuff because I understand mezzanine finance and things like that. Or, just being able to do a lot of deals. We wanted to do that, and we needed a special structure to do that. And that took a lot of time legally to do, but we're very happy with what we have. And with the book that's being launched, and we're just getting into PR now, I think it's going to be a very fun fall and end of year coming up.
Right. So, and then your company, basically, you're serving folks by basically growing their wealth for them and taking care of it, being stewards.
Yeah, I wouldn't say growing. I mean, growing it is one thing, but I think today it's more or less preservation. That's what it is. People don't know what they're doing, and we've started a social component of it too, because people today want, especially the younger generation, the millennials, they want that experiential component. So we're getting ready to sort of bring that into market, if you will, at some point before the end of the year. And then it's more like society investing with people with common values, investing in things that they like. Mm-hmm. But for these families, we basically leverage our experience to make sure that they're getting into the right assets, which isn't going to embarrass them later. For example, if you are, and you know this, but a lot of people on the call don't know this, if you wanted to start a foundation, for example, for a special cause, how are you going to fund that? Well, you'll say, Sal, I have $5 million. I think I'm going to buy a bunch of single family homes in Kansas City. That is not something that's sustainable, because you can't run a foundation off of the creditworthiness of a couple hundred single family homes. Just because they live there doesn't necessarily mean they'll have a job tomorrow or they're obligated to pay rent, as we're seeing right now. So these are kind of the mistakes in mapping that we do to protect a lot of these families who have a lot of money, but they don't really know how to do it. And a lot of people aren't going to tell you that. So that's one of the reasons why I wrote the book, is sort of to give a handbook of like, what would, what have your contemporaries done before you? And there's really two sets of families today. There's the emerging families who are like the nouveau riche. They came into, tech IPOs. Maybe these are people who are selling e-commerce companies, one a month for, a few $1 million or something. And then there's the established families, like the Rockefellers, people who we invest with. And they're mentioned in my book, actually, too, Investing Legacy. and they have much more of an institutional look at the world. And it's the emerging families are the ones who are problematic or face their own challenges because they're still trying to evolve themselves and try to find their identity. They're still in that, phase where they're buying the second house, they're getting a second wife, maybe they have the sports cars, the Rolls Royces. They're still trying to come into their own. So they haven't really established themselves yet. Once they get through all of that stuff, then they're like, okay, now, I'm tired of screwing around. How do I build legitimacy through my resources, through my wealth? And that's where it's like, okay, well, if you're looking for that, now we're talking about higher class statement assets, such as, for example, partnership interests in professional sports teams and fine art lending, class A assets, and anything else that has a higher barrier to entry other than finance or financial.
Listen, I know a professional Major League Soccer team in Salt Lake City that needs an ownership group in the workplace. I'm a huge fan, season ticket holder, but I can't buy them yet. I'd love to, but I'm just not there yet. So listeners,
think about it. It's a very insulated brand, right?
Absolutely. And man, you want to invest in, amongst other things, you want to invest in what you know and like and know and love, right? Ultimately, I mean, Warren Buffett would say that. And so it would make sense for me. But so I'm looking at right now at the top 10 mistakes that prevent you from building an investing legacy download that listeners can go download at your convenience at investinglegacy.com/gift. So investinglegacy.com/gift. Give us one of those, one of the important mistakes that prevent someone from building an investing legacy. Maybe like a key one that we all should.
Yeah, here's one that gets it all the time. Ready?
Yeah.
Taking investment advice from sell side brokers and advisors.
There you go.
If you're asking a sell side broker at Marcus and Millichap if a 2-cap is a good cap rate to buy an apartment in a town 2 time zones away from you, chances are you're going to get screwed. Not you're going to get screwed, you're going to make a mistake. But it happens too in finance. When anybody wants to get involved in like these pre-IPO deals, they're usually very diluted. They're usually a lot of fees, and you got to look at who's showing you the deal, right? And that's really what it comes down to. So for those getting started, don't be cavalier. Don't go getting advice off of mortgage brokers who have an asymmetric fee structure, an asymmetric alignment of interest with you because they're making fees. You got to go with people who have done it. And especially if you have any means whatsoever and you're scared, you should probably invest alongside an experienced operator so that you can learn the ropes and understand what happens and look over the shoulders before you start going out and being a hero yourself by taking on all the operational leverage. Now we're dealing with political risk that deals with anything as it relates to regulatory issues with real estate, developing or rehabbing it, value added or whatever.
Right. Yeah. And right there, guys, I mean, go back 30 seconds and listen to that again. That's like really good key takeaway stuff. And like this space is like ripe right now, right? There's tons of opportunity. There's tons of capital. There's tons of cheap debt. The deals are not so plentiful, right? Like we'll just say it like it is. It's tough to find a deal right now, especially if you're using criteria that you were using 5 years ago. It's going to be real hard to find a deal. But that said, they're there, and we're finding them. Sal's group's finding them. And lots and lots of my colleagues are finding, and we're closing on a deal tomorrow. We're closing on 51 units in Oklahoma City.
There you go.
Yeah, 192 in 30 days in Oklahoma City, and then 60 in Ohio, and 60 doors in Ohio in about 60 days is what we're looking at here in the near term, and then other things in the works. So I'll just let me just kind of put this we'll kind of start to hone in here a little bit and round things out. My team has led with a very much a deal first approach. And I'm not saying that's a good thing. I'm not bragging at all. I'm just saying that's kind of how we did things. And what I mean by that is that we spent 2.5 years learning how to underwrite, learning how to build broker relationships, learning how to go direct to seller, and really getting the whole deal finding, deal making thing like going. And once we got those, we actually got 2 on the line at the same time in Columbus, and a 70 unit and 179 units. And all of a sudden we had to raise $6 million. And yeah, we
welcome to my world. Yeah.
Right. And
put another 0 on that though. Yeah, I know.
Right. So for us, that was huge. And we did it somehow. We pulled it off. And but we've got a platform, we've got a landing page, I've got a downloadable ebook. So I'm building our email list and marketing to it. Beyond that, aside from doing good deals and being a good person and doing what I say I'm going to do, which is my MO anyway, what would you say to someone that's in the place I am, going on 300 doors under management?
I'll tell you what's stopping you right now from going further.
Mm-hmm.
You are not communicating enough with your investors.
Okay.
You should have a letter going out that looks like mine. It doesn't have to be as long, but it should be, hey, this is what we're doing. This is what's great. Because those letters, and here's the key, you write the letter in the format where it makes the reader feel special. It doesn't talk about you, it talks about us. And those are the letters that get forwarded around. Look at what I'm in. And then before you know it, these people start coming at you. Really, I did a podcast with Oliver Graff. It has 35,000 hits at the time. Right now, it hits 1,000 each day. And
wow.
He all of a sudden now is starting to monetize that and understand how to do with it. But I think with you is you need to go out there and just say, hey, this is a book I'm reading today. This is a great book. And it doesn't have to be mine. But I think when you write letters to people, it's first of all, it's the easiest sales technique you can use, because when people read a letter, they understand you. There's love letters, there's hate letters, there's poison pen, you can name it. But when you write an investor letter that's just maybe 5 pages or so, it tells people that you care about them, that you're on top of it. That's what I would do. Besides the deal toys, I would send out an annual deal letter. That's it. That's all I would do.
In addition to quarterly newsletters, of course, the normal investor communications.
I mean, that's normal for you. For me,
okay.
You do that because your investors are new and they think they're a mutual fund, and some of them probably think that they're liquid and they're not, and all that. So, I do the quarterly stuff, and, we do that, but now I bring an intern in and they do that, and I just fill in the blanks with my own tone. But I do it because I have so many companies with one fund, I can only do it once a year, in our segmentation,
sure.
In our software, they can see the details and everything. But as far as getting the full treatment, this is what I think. And, I don't talk politics on Facebook. You have to scroll through my performance first before you see, what I'm actually thinking. That to me adds a lot of value. But if you're putting a letter out there and you're talking to people, not even with the reports, but just a letter, you put it at the end of the year. This is what we accomplished. This is what we've done. By the way, we have this one guy that's joined us. We have start and then forecast a little bit, but don't forecast. We're just say, hey, I'm starting to see that there's a lot of pressure in certain areas. We've been talking to people on Wall Street, who are seeing distressed debt, and, we're seeing opportunity there. Maybe that, we might be able to participate in much better deals because we're getting it at a much better basis and we don't have to compete, or things like that really make people feel like, wow, this guy's on top of it. He knows what he's doing. I want to align with him.
Mm-hmm, mm-hmm. So,
another thing too that you guys should probably do is invest in is some sort of strong administrative software, because that's really going to differentiate you from your peers. A lot of people are using their spouse, when they're starting out, as like an accountant, but they don't pay them anything. But if you don't pay anyone, they don't do a good job, because your heart is where your treasure is, right?
Yeah,
you get it. So, but I think there's services out there, and I'm not endorsing it, like Juniper Square, for example, where your investors go in, they see your green light logo, they see everything here, the distributions and stuff. That makes people feel really good too as well. And that is that's just like for people who are coming into it, it's like, wow, these guys really know what they're doing, they're taking it seriously. But most importantly, people want to know, I know you're a good guy and I know you're going to do the right thing, but I don't know that if I didn't if I didn't know from Adam, you know what I mean? Or anything like that. So you really need to be able to communicate consistently. And just like anything else on social media, the more consistency, first of all, the more voice you have, the larger the voice, but the more people will stick with you and not be tempted to go off onto maybe half-assed things like, I don't know, like, initial coin offerings or other stuff, that shiny objects. It'll show that you're sort of like you're a provider and you're the man in the room, you're the grown-up men and women in the room, and this is what you think, and you're not going to deviate and all of a sudden sell CBD products next week.
Right. Yeah. Yeah. And look, that means the world to investors, right? Like,
yeah,
there for the long term, and you're asking them to be there for the long term as well. So
they're your biggest advocates.
Absolutely.
Because once you give these guys a check, they're not going to be able to shut up about their friends saying they're in this great real estate syndication and they already got checks.
Mm-hmm.
And then they're like, really? Because everybody's got the greed gene, right? So now they're going to search you down and they're going to fill out your page and download your propaganda. And then you have a new investor now.
Right, right. Well, Sal, this has been like a little bit like drinking from a fire hose for me, and one of the best, and I mean that in the best way I can mean it. This is
I had a little too much coffee today. I'm sorry.
Oh, I love it. I love it. I had a lot of coffee today too, so I stayed right with you. Hopefully our listeners at Investor Guys Nation are drinking coffee too. But no,
I would urge them to download the report, because I think a lot of people, before they start, these people have, dreams, but when they get to it, the real world can be kind of tough for developers, right? Maybe that's something you can put into your letter, actually.
Yeah.
Don't do this. But if they download the report going to investing
let me pull it up here.
Sorry.
Sal gets choked up when he starts talking about his business. So this is investinglegacy.com.
Yeah, /gift. Yes.
Yeah.
Investinglegacy.com /gift. Thank you.
That's your download. And then where can people buy your book?
They can go to investinglegacy.com /book.
Awesome. I'm going to go there.
Yep.
I'm going to check it out, and maybe going to buy it for my investors as a little gift for everybody. So
you should. And if you want to do that, let me know, because it's expensive.
Okay.
Because we don't want any local yokel, you know what I mean? So just a warning out there, it's expensive on Amazon. It's the same price wherever you go. It's fulfilled by Amazon. But if you go to investinglegacy.com, you get the free the free report, which is worth its weight in gold. Actually, it has billions of dollars in research and development and other people's losses.
Wow. There you go. All right, Sal. Well, any departing last words of wisdom for folks that are, breaking into the multifamily space and are here to learn from you?
Yeah, I think I think coming into this space, this isn't residential, this isn't single family homes. If you want to get into commercial, whether you want to be in multifamily, you want to do distress, you want to be a developer, you have to learn how to raise capital. If you're not raising capital, then you're not going to be successful in this business. And you have to be confident talking to people openly, just like Tate is. You don't have to necessarily have a podcast, but you have to be enthusiastic and almost evangelical about it.
Do you have an elevator pitch, Sal, when people ask you what you do?
I do. There's one version which is not politically correct, and then there's the other version. But
give me the politically correct version. Let's
okay, yeah. So I basically what I say is I'm a professional investor for several families in New York, and we allocate into world-class statement assets, whether it's in real estate or venture capital, who are led by world-class teams who have had many exits.
Wow, that's boom. That's power. That's powerful.
Mm-hmm.
That's good stuff.
Yeah.
Everybody work on your elevator pitch. You should have something ready to go. Like somebody asks you.
Always.
You should have it, and it should be. You should have raising capital in there somewhere. It needs to be there. Like it just.
Yeah. I mean, that's my final words. If you're not comfortable raising capital, you should not be in this business.
Yep. I agree. All right, Sal. Well, listen, thank you so much for this informative time. And I can't wait to go back and listen and add to all the notes that I already took.
Sure.
Listeners, thanks for listening to another episode of The Apartment Guys, and we will catch you next week. Take care, everybody.
Take care. Thank you.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.